Hello everyone, welcome back. Today we'll be discussing on this particular topic, weighted average cost of capital. Today we'll be looking at these 5 questions where I'll be covering this particular question, like what is weighted average, then what is cost of capital. So these questions nothing but breakup of this particular thing, weighted average cost of capital. Then we'll be having a look at the formula for WACC, and then I'll be breaking down the formula for WACC, and we'll be analyzing each part of the formula. Then we'll be looking at why do we calculate WACC? I mean the importance of WACC, and the common mistakes what we can do while we calculate WACC. So let's get started. So let's take up our first topic of discussion, which is weighted average concept. So what this particular thing means. So let's understand this with the help of an example where our company Valonomy, it has, let's say it has a debt of 10 CR and equity which is 10 CR, this, and its total capital is 20 CR. ओके, वैलोनॉमी का टोटल कैपिटल है जो 20 CR है. अब वैलोनॉमी को उसका वेट ऑफ डेट एंड एक्विटी वो कैलकुलेट करना है. ठीक है, तो लेट्स अंडरस्टैंड दिस फर्स्टली विद द हेल्प ऑफ द फॉर्मूला. Okay, and then we'll be having a look at the number, like what that number means, right? So the formula is let's say for debt, weight of debt is debt upon total capital, and for weight of equity it is equity upon total capital, right? Is 10 CR upon 20 CR, here 10 CR upon 20 CR, 0.5, 0.5. All right, we had a look at the formula, but what this number means. So this number, if we look at this number, it's nothing but the ratio. It's the ratio of, let's say in case of debt, it's the ratio of debt to total capital, right? In other words, it means कंपनी के पास कितना डेट है उसके टोटल कैपिटल का. ठीक है, and in case of equity it's the ratio of equity to its total capital. All right, so weighted average is nothing but it's the ratio of capital. Capital can be debt capital or equity capital. It's the ratio of capital to total capital, ratio of capital to its total capital. All right, now let's have a look at another concept of cost of capital. So let's understand our second concept, which is cost of capital. As we saw earlier, our company Valonomy, it has debt of 10 crore and equity capital of 10 crore and total capital of 20 crore, right? Now this capital, the providers of this capital, right? The providers of this capital must be expecting something, like, let's say debt holders, they must be expecting, let's say, interest, right? Interest on the this 10 CR portion. And equity holders, also known as owners, they must be expecting dividends, capital appreciation, right? Capital appreciation. So in short, it means that this capital is not for free. It's not free. Okay, it's the capital is not free, right? The company must be paying debt holders and equity holders something in return for this capital, right? So what is cost of capital? So cost of capital is nothing but the expected return, expected return. It's an expected return by whom? By the providers of capital. Providers of capital. So it's the expectation by the providers of capital. So debt holders basically, so they must be expecting. So it's called the expectation by the providers of by the provider of debt. It's called cost of debt. Cost of, also known as KD. And expectation by equity holders, also known as cost of equity, known as KE, is cost of equity and cost of debt. So yeah, to summarize, it's an expectation, it's an expected return. My bad, it was not by the providers of capital, it is to the providers of capital. Okay, it's to the providers of capital by the company. Okay, so this was all about the cost of capital. Now let's look at the formula of WACC. Third topic of discussion, which is WACC formula. And we'll also be taking the analysis of the formula in this particular coverage. So yeah, let's have a look at the formula first. So the formula goes like this, which is debt upon total capital multiplied by cost of debt 1 minus tax, add equity upon total capital into KE. Okay, so this is WACC, this formula for WACC. So basically ये फॉर्मूला थोड़ा बड़ा दिख रहा है, बट सिर्फ वो दिखने में बड़ा है, and it's actually a very easy formula. It's a very easy formula. So let's have a look at the analysis of each and every component. Okay, so let's first touch upon this particular thing, which is debt upon total capital. So as we saw in our first topic, which is weight. Okay, this is nothing but the ratio of debt. Okay, ये debt का ratio है of total capital. So in short, it's like let's say मेरे जेब में टोटल 100 रुपया है, total 100 rupees I have in my pocket, and of that 100 rupees 50 rupees belongs to me, it's my, and 50 rupees is, let's say I took it from my friend as a debt. Okay, so of this total 100, 50% is 50%, or let's say 0.5 is debt, and 0.5 is equity portion. Okay, so this is the basically weight of debt. Okay, weight of debt. Now what is KD? KD is basically cost of debt. Let's say if my friend is asking something in return, let's say 10% interest, okay, on the capital, right? उसने मुझे फ्री में तो नहीं दिया है मुझे कैपिटल, सो वो बोल रहा है कि if I have lent you something, then I'll be charging 10% or as an interest on that particular capital. Okay, so that is nothing but the cost of debt, which is expectation by debt holder. Okay, let's take up this particular thing at the end. So before that, let's come here, which is ratio of equity to total capital. Okay, the ratio of equity to total capital, कितना ओनर्स का पैसा लगा है कंपनी में ऑफ द टोटल कैपिटल लेट्स से 20 CR का था हमारे पास में, उसमें से 10 करोड़ रुपया ओनर्स का है, तो बेसिकली 50% ओनर्स को बिलोंग करता है 20 CR में से. ऑलराइट, एंड दिस पार्ट इज कॉस्ट ऑफ इक्विटी, which is expectation by the equity holders. Now what is this particular thing? This 1 minus tax is nothing but tax shield. So let's understand this concept of tax shield. Okay, what is tax shield? For this, let's take up two scenarios. Scenario 1 and second scenario. Okay, let's say Valonomy has a bit of earnings before interest and taxes of $100,000. Okay, and interest component is 20,000, and tax rate is, let's say, 30%. And in scenario 2, Valonomy has the same EBIT of $100,000, whereas interest portion is nil and tax rate is 30%. All right, so we want to arrive at earnings after tax. Okay, so how our calculation will look like. Okay, so let's begin with our calculation. So EBIT, which is $100,000 minus interest of $20,000, we arrived at EBT, earnings before tax, of $80,000, right? And we will be deducting tax at 30%, which is $24,000, and we will be getting EBIT of, not EBIT, earnings after tax of $56,000. 56,000, right? In second scenario, EBIT goes like same as scenario 1, $100,000 minus interest, which is nil. So we got EBT of $100,000 and tax at the rate 30%, which is 30,000, and it gives us 70,000, right? Of earnings after tax. Now what is the difference between these two, right? The difference is what? Interest portion, right? So in scenario 1 we had interest of $20,000, and in scenario 2 we have interest of nil. Okay, now what's the benefit of paying interest? What is the benefit of paying interest? So the benefit is like this. As we saw in our tax expense, okay, tax expense in scenario 1, tax expense is $24,000, whereas in scenario 2 tax expense is equal to $30,000. All right. So in scenario 1 we are saving $6,000. Okay, $6,000 of so the difference is basically $6,000, right? So we are so if we are having this interest component, then the company will be saving on $6,000. The what is $6,000? Okay, $6,000 is nothing but the effect of tax shield. This is nothing but the effect of tax shield the effect of tax shield, right? So it goes like this: $20,000 into 30%, which is $6,000. So in short, whenever the company is paying interest, so interest is considered as an expense, and on that expense company will be saving so saving on the tax part. Basically company is getting tax benefit, so that tax benefit is called as tax shield, which is $6,000. All right. So we had a look at the concept of we had analysis of the formula for WACC, and we had a look at the concept of tax shield as well. Now let's understand why, like, what is the importance of WACC, which is importance of WACC, and common mistakes, what we do while calculating the WACC. Let's take up our last topic for this reading, which is importance of WACC and common mistakes which happens while calculation of WACC. All right, so let's touch upon this part first. Importance. So first is performance, performance measurement. Okay, so the WACC helps us with the performance measurement. So what does this thing means? Okay, let's say company, let's say Valonomy. Okay, Valonomy is generating return of return, like this means return on invested capital let's say return on invested capital is 24%, whereas WACC to the company is 20%. Okay, ROIC is 24% and WACC is 20%. So what does these two numbers means? इसका मतलब क्या है? So by this we can say that company जो रिटर्न कमा रही है by investing the capital is 24%, whereas जिसने भी capital दिया है basically debt holders and equity holders, उनका expectation है 20%, right? So it's the positive return. It's the positive return on invested capital, right? So WACC calculation helps us with the performance measurement. Let's say अगर हम WACC calculate नहीं करते, ठीक है, then हमें ये picture देखने नहीं मिलता, right? So this is one of the importance of WACC, right? The second most important thing with the calculation of WACC is valuations. Let's understand how it helps. Okay, so valuation is basically done, whenever, let's say, a company wants to raise new fund, or it is going ahead with the M&A deals, etc. Okay, so valuation is done, right? Now how this WACC helps, right? So WACC is basically used as a discounting factor. Okay, discounting factor for what? To get the present value of free cash flow. Okay, so just for this short video, just understand it is used as a discounting factor. All right, basically if we are getting in this valuation part, then video will stretch like anything. So just for our understanding, let's keep it short. So it's used as a discounting factor. All right, the third part is capital budgeting part. Okay, so let's say a company wants to acquire a new machine. Okay, let's say this is a machine which costs around 20 CR. All right, and company wants to acquire this thing, and let's say company wants to do an analysis, and it wants to calculate the net present value, NPV, net present value, which is calculated as present value of cash inflow minus present value of cash outflow. All right, now PVCO is basically what we are investing. जो आज हमने इन्वेस्ट किया, हमने 20 करोड़ रुपया दिया और हमने ये मशीनरी अक्वायर कर लिया, राइट? बट हाउ इज दिस PVCI calculated, which is present value of cash inflow? How it is calculated? So this calculation happens where we bring all the cash inflows. Okay, whatever the returns will be generated by this machine, it will be bought back to the present value. Okay, it will be bought back to the present value, right? This will be the present value. Now, but how is WACC important, right? How is WACC important? So WACC is used here as a discounting rate, where the inflows are discounted and it is bought back to its present value to get the net present value of the investment. All right. So there are like other importance as well, but these are the most common importance of the calculation of WACC. Now let's get on the common mistakes. All right, mistakes which happens in calculation of WACC. All right, so before we go ahead, let's write down the formula first. WACC is equal to debt upon total capital into KD 1 minus tax add equity upon total capital to KE. Alright, this is the formula. We saw it earlier, right? Now what are the common mistakes which happens while calculation of WACC? So let's understand from where we will get the debt number and this total capital number. All right, debt and equity, like what do we mean by this, and from where to get these numbers, right? Let's say if we take these numbers from balance sheet, right? If we take this number from balance sheet, which gives us the book value, then it will be incorrect, right? So remember, it's important, always take market value of debt and equity. Okay, always take market value of debt and equity rather than book value. Book value is incorrect, right? So people take book value and the calculation goes wrong. Now the second most important part is ignorance of tax shield. Ignorance of tax shield, where this component is ignored, and the whole calculation goes for toss, right? So never ignore tax shield. Never ignore tax shield. All right. Never ignore tax shield. Now the third most common mistake is in calculation of cost of equity. All right. Well, we'll be touching upon this part of calculation of cost of equity in our upcoming videos, but just for our understanding, KE is calculated by using CAPM, which is capital asset pricing model. Okay, capital asset pricing model, right? Now, and the formula for this is RF plus minus RF into beta. Remember, just for this video, and to keep it short, let's say if any of these components, if any of this component is incorrect, then this will be impacted. All right. So that's the reason. Okay, we should be very careful. Whenever we are calculating cost of equity, then whatever inputs we are taking in our CAPM model, we should be very careful on that part. All right. And the last most common mistake which people do is ignoring other capital component. As we saw in our formula, that here we have debt upon total capital and equity upon total capital. All right. Let's say if the capital structure also has preference shares, all right, then, and if we are not including, and if not included, then calculation will be incorrect. All right. So always see the capital structure and then go ahead with the calculation of WACC and cost of capital. All right. Sorry, always go ahead with the calculation of WACC. All right. Always look at the capital structure and then go ahead with the calculation of WACC. So guys, these were like few of the mistakes which commonly happens in calculation of WACC. So the objective of this video was just to touch upon like a few important parts of the WACC calculation and a few concepts. So with our upcoming videos, we'll be touching upon the concept in more detail. So till that time, stay connected. Thank you so much for your time and all the best for your future.